Welcome back, focused learners. Today we're jumping right into an explainer that is going to tear down a massive illusion hiding in almost every corner of finance. I'm talking about the immense danger of relying on static, single numbers in financial valuation. Whether you're looking at discounted cash flow models or relative valuation, there's this really common and honestly kind of terrifying theme. We tend to take all the complex, dynamic, chaotic risk of a real-world asset and just cram it into one single number, like a slightly higher discount rate. It's literally the financial equivalent of wearing a blindfold on a roller coaster. But what happens when that one magic number is hiding a massive blind spot?
Just imagine this for a second. You've spent weeks building out your entire discounted cash flow model. It looks beautiful on a spreadsheet, but we all know that universal pain, right? That supposedly perfect Excel model that just totally breaks the second it meets reality. What if your model is actually completely fragile? What if it crumbles because it rests on a single, flawed assumption that's masking the true potential for total ruin or, hey, maybe even incredible upside? When we try to capture all the wild, different possible outcomes of the future in just one single expected value, we are walking a tightrope without a safety net.
Okay, let's dive into this. Traditional, static DCF models act almost like a vice. They're incredibly restrictive. They force you to compress every single real-world uncertainty into one static discount rate or one expected cash flow. But probabilistic approaches, they open this right up into a dynamic web of possible outcomes. This is where valuation gets real. Rather than giving you a single point estimate, a probabilistic approach reveals a whole dynamic range of possibilities across both good and bad scenarios. It actually helps us map out the unknown.
So here's our game plan for this explainer. First, moving beyond static valuation numbers. Second, mastering scenario analysis. Third, tackling sequential risk trees. Fourth, running Monte Carlo simulations. And finally, avoiding the dreaded double-counted risk. Let's get to it.
First up, Section 1, moving beyond static valuation numbers. If you're a modern analyst, you simply have to move past the illusion of precision that those traditional models try to sell us.
Look, when you use a traditional valuation approach, you are essentially forcing incredibly complex real-world risks into a single restrictive discount rate. Think about it. If you're valuing a company, you're dealing with macroeconomic shifts, unpredictable competitor responses, sudden regulatory changes. Wrapping all of those diverse, completely different future risks into one single percentage point, that is a massive disservice to reality. As a decision maker, you don't just want some arbitrary expected value. You want to know exactly what the asset will be worth under specific, actionable conditions.
And that brings us to the first and really the most foundational probabilistic tool in our toolkit. Section 2, mastering scenario analysis.
Now this goes way beyond basic best case and worst case guesswork, which, let's be honest, isn't very informative anyway. We need to systematically build this out. First, you got to isolate the heavy hitters. What are the 2 or 3 critical factors that will genuinely drive value? Maybe it's the overall economy or specific regulatory behaviors. Once you have those, you build out your distinct worlds, keeping it to a manageable 3 to 5 scenarios so you don't just drown in data. Third, you estimate the actual cash flows under each of those specific scenarios. And finally, you assign realistic probabilities to each one. This builds a really robust, 3-dimensional picture of your risk. And this brilliantly illustrates exactly what we mean. Imagine valuing Wells Fargo's equity back in early 2009, right as the banking crisis was wreaking absolute havoc. A static model would just spit out one single, highly questionable number. But a multiple scenario analysis breaks it down so clearly. Looking at this matrix, we see a 10% probability of a quick bounce back, valuing equity at over $126 billion. A 60% chance of a slow bounce back sitting at around $81 billion, and a 30% chance of a new world order dropping it all the way down to about $53 billion. By weighting these, sure, we get an expected value of around $77.6 billion, but more importantly, we actually get to see the tangible, real-world range of our risk exposure.
But what if your risk isn't happening all at once? That takes us to Section 3, tackling sequential risk trees. This is where we shift our focus from concurrent risk to sequential risk, where events actually unfold in crucial, distinct stages over time. For sequential risk, we build what's called a decision tree. And the architecture here is just fascinating. You start right at the root node. That's the choice you face today. Then you map out event nodes representing uncertain outcomes, decision nodes where you can actually react to those outcomes, and end nodes which represent your final potential values. The real magic, though, happens in step 5, folding back the tree.
It's kind of like time traveling. You calculate the probability-weighted values at the very end of the journey and pull those realities all the way back to the present day. Put yourself in the shoes of a decision maker trying to value a young, single-drug biotech firm. You absolutely cannot just average out risk here. The chaotic unpredictability of biotech trials demands precision. I mean, if that drug enters phase 1 of an FDA trial and fails a safety test, it is game over. The value drops instantly to zero. Failure at literally any single stage means a complete and total loss. Decision trees force you to explicitly respect this all-or-nothing survival-based risk, rather than blindly blending it into some general discount rate.
Let's move to and see how this builds into our ultimate tool. Section 4, Monte Carlo simulations. This sits right at the very top of our hierarchy of complexity.
While scenario analysis and decision trees deal with distinct stepped outcomes, like passing a drug trial or a specific economic shift, the real world is much messier. We call this continuous risk. Most risks we face generate thousands of fluid, shifting outcomes. An interest rate doesn't just go up or down, it moves continuously along a spectrum. When outcomes aren't just simple binary choices, Monte Carlo simulations are absolutely strictly necessary to get a full, accurate picture.
And the mechanics of this are just incredibly clever. First, instead of picking one single expected number for, say, market growth, you define an entire probability distribution for that key input. Second, the computer draws one random outcome from each input's distribution and calculates the cash flow. Finally, you run this process thousands and thousands of times. What you get at the end isn't a single point estimate, but this beautiful bell curve of present values. You can literally physically see the shape of your potential future, all the way from the catastrophic tail-end risks to the highest possible upside.
But as always, with great analytical power comes a massive pitfall. Section 5 is a crucial warning: avoiding double-counted risk. This is easily the single most dangerous mistake analysts make when wielding these probabilistic tools. There's a massive trap here, especially when dealing with venture capital or startups. Look, if you build a decision tree that explicitly models the probability of a startup failing at various stages, those cash flows are already adjusted for risk. If you then take those expected cash flows and discount them at a massive 35% target rate just because startups are risky, you are completely destroying your valuation. You've fundamentally broken the model because you are punishing the asset twice for the exact same risk.
So, the crucial point is this: do not double count. If you run a Monte Carlo simulation and you discount those cash flows back at a risk-adjusted rate, do not turn around and reject the investment just because the simulation shows a high variance. The expected values you derived are already accounting for that risk through the discount rate. If you want to use the simulation's variance as your margin of safety, then you absolutely must discount those cash flows at the risk-free rate. You can adjust the cash flows or you can adjust the discount rate. You cannot do both.
Now, what's really interesting about this slide is how it brings everything together. Ultimately, it all comes down to aligning your specific problem with the right solution. Think of this as your ultimate risk approach matrix. If your risk is discrete and sequential, like that FDA drug trial, you use a decision tree. If your risk is discrete and correlated, like distinct macroeconomic states, you use scenario analysis. But if your risk is continuous, with thousands of fluid possibilities shifting every single day, that is when you deploy the heavy artillery, Monte Carlo simulations.
I want to leave you with a somewhat provocative thought today. Think about the spreadsheets you're going to open tomorrow morning. Do your current valuation models actually capture the dynamic, multidimensional future, or are you resting the entire fate of an investment on a single, flawed guess masked as an expected value? It is time to move beyond static numbers, master these probabilistic tools, and start properly valuing the unknown. Thanks so much for joining me on this explainer, and as always, keep learning.